Hello, chart watchers, and welcome to this Tuesday, September 3rd, 2019 Market Watchers live show with your hosts, Tom Bowley and Aaron Swendon. Oops. Today's show is actually a little different. I am not Tom Bowley, and my partner in crime is not Aaron Swendon. My name is Julius the Kempenaer, and my co-host today is David Keller, and we will be presenting this show. And because neither Dave or myself has ever flown solo on Market Watchers Live, please be gentle with us. We'll try to keep you as entertained as possible, and we'll monitor the chat channel. Anyway, for those of you joining us for the first time today, welcome to the show, and be aware of the fact that this is not the normal Market Watchers Live setup. For our regulars, welcome back. We do our best to give you just as good an experience as you are used to get from Tom and Aaron. Let's take a look at the markets. What's happening here? We see a bit of red. I'm not doing it like Tom. I'm just working from my market overview, and I see red for pretty much all indexes. And my day starts with looking at sectors, and I do that from an RRG point of view. And you can actually get a pretty good overview of what markets are doing by just setting your tail length to one trading day, and you'll get the change from yesterday's close. And you'll see that the pretty much defensive sectors are doing pretty well. Real estate up 1.2%, utilities 1.1%, staples and discretionary actually is good. The S&P itself down 0.6%, and then all the way down we got financials and industrials. That's it for my start of the market, and I want to introduce Dave Keller to the show. Hi, Dave.
Julius, good to be with you as always. How are you?
Yeah, I'm good. I wonder how you're doing, because you have just finished a 4-day road trip, 5-day road trip?
Thank you for asking. It was 5 fantastic days on I-90 West, 37 hours of driving altogether with 2 small children and a dog. So think of me well for surviving and being here live on Market Watchers Live in shape. Yeah.
Because you're actually going to join the StockCharts team in the mothership in Redmond. That's super exciting.
Super exciting. So move to the Pacific Northwest. It's a big change for my family and everything, but it's a super good group of people here. And yeah, I mean the listeners I know are familiar with StockCharts, and there's so much upside I think for the product and where they're headed. So I'm pretty jazzed to be here and working full time with them starting tomorrow.
Yeah, I'm really excited to work with you as well, Guy. We're going to talk about a little bit later about our relationship in the past as well. But I'm super excited to have you on board with StockCharts, and I'm sure we're going to have a lot of very nice things to come for everybody. I believe you are going to talk us through the upcoming schedule and the agenda for today, right?
Absolutely. So, coming up the remainder of this week, we've got a couple fantastic guests on Market Watchers Live. Everyone on September 4th, we have Linda Raschke, always really interesting stuff from her, and then Bruce Fraser, expert on the Wyckoff method and a fantastic educator on September 5th. And then going into next week on September 10th, Aaron will be back doing Aaron's workshop, which is always good. I love anytime you can get inside the head of someone who uses StockCharts regularly and well. I find it's time well spent. So that's probably worth checking out. Coming up for today, folks, what we're going to do together is, as Julius mentioned, please be kind. This is our first time doing this solo, but I think hopefully you'll find it time well spent with the two of us. What we wanted to do, Julius is, as most of you know, very an expert in sector rotation and creator of the RRG methodology that a number of us have been using for years and years, and now all of you have access to. We're going to do a deep dive into the consumer sectors. As we were talking about the market environment and where we wanted to look, we found that between consumer discretionary, consumer staples, there's some really interesting themes when you look at the sector level, then the group level, and then at the single stock level. And what we wanted to do for you is just basically put you on our shoulders for a little bit and have you sit next to us as we go through those 2 sectors and kind of unpack what we're seeing. After that, we'll take a quick break and we'll come back with the 10 in 10. And the first stock we'll be looking at is Kellogg, ticker symbol K. And as a reminder for those of you that aren't as familiar with Market Watchers Live, go into the chat room anytime and go ahead and put tickers that you'd like us to review, and we'll incorporate some of those into the 10 in 10 segment later. Today is just a chance for the two of us to go through and share what we're seeing, looking at some of those individual tickers. Also, as a quick reminder, we have the poll open, and on your screen looking at StockCharts TV, we have the poll, and we're going to ask about a screen that we'll be referring to later called the industry summary screen. So I'd love for you to take a second look at the poll, see what, and share your feedback on where you're at with it, so we can refer to that later. I'm going to take the screen over and just do a quick update, Julius, on what I'm seeing with the markets. Thanks for the market update at the beginning.
No problem.
For me, what I'm going to do, I have a chart list that I've created called the Mindful Investor Live chart list. This is related to my blog called The Mindful Investor. And if you're not familiar with the chart list, or if you're interested in what you're seeing here, just shoot me an email after the show. It's davidk@stockcharts.com, and I'm happy to share with you the link to this chart list. But this is one of the tools that I look at every day just to sort of orient myself to what's happening with the markets. And I'll talk you through what I'm seeing real quick. What I like to start with is a long-term perspective. And I know many of the listeners are more long-term investors. Some of you may be short-term, and that's great. But no matter what, you should have a good read on the long-term market environment. And what I like to do is start with the time frame that I'm investing in. So if I'm a long-term investor, you better start your day with a good long-term orientation, recognizing where the trends are so that you're not too caught up in the short-term flickering ticks of day-to-day movements of the markets. You're following the big picture. So here we see a long-term weekly chart of the S&P 500. This is with two long-term weekly exponential moving averages, just tracking the overall trend to the market. And then here we have a PPO, which is basically just showing you the relationship between these two exponential moving averages. And essentially, as long as this is above zero, as long as the shorter moving average is above the long term, then the long-term trend is positive. And what we've seen is that turned positive earlier this year, has remained positive, even with all the volatility, with all the corrective movements, with all the stocks that have done well and then have rotated. Overall, the trend is still positive. And until we get a significant breakdown and start to register sell signals there, the long-term trend, the very long-term trend, the secular trend still appears to be positive. One of the charts that I spoke about recently on a blog, and I forget if it was in the Mindful Investor on ChartWatchers, which Julius and I and many other commentators contribute to, that comes out Saturday for everybody. One of the charts I refer to is looking at the breadth of the S&P 500 by cap tier. So breadth, again, is a common way of just looking at how all the stocks within the index sort of roll up to the big picture. And in this case, we're doing it in the form of the advanced decline line. So how many stocks are closing up or down on the day, and you roll that up over many days, many weeks, and you get this indication. This is the S&P 500. You can see that overall, the advanced decline line is making new highs. So even with the market coming off a little bit, the advanced decliners, the breadth measures, are actually making new highs, which is incredibly healthy as a pure, in a vacuum. That's actually very encouraging. But one level lower is where it gets a little more concerning from my perspective. So here we have breadth, or the advanced decliners, on the mid-cap stocks, and then advanced decliners on small-cap stocks. So while the broad S&P, mostly large mega-cap names, has actually broken to new highs, sort of confirming that we're in good shape, the mid-cap, small-cap breadth is actually not confirming those new highs. Now, again, the market can definitely go higher with that configuration. It's not saying that it's a raging sell signal, but it's certainly a red flag. It's something that I pay attention to, because you'd want to see these smaller, more speculative names driving higher if this is really more of an extended move. The next chart I want to show you, just related to the discussion we're going to have today. One of the, there are a lot of ways I like to look at just confirmation with different slices of the market. So I'll look at relative performance of semiconductors. In this case, we're looking at offense versus defense within the consumer sector. So here we're looking at just a simple ratio of the consumer discretionary ETF XLY and the consumer staples ETF XLP. And again, just the ratio of one versus the other. And very simply speaking, when this ratio is appreciating, when it's going higher, that tells you that institutions overall are betting more on the offensive side of the market, betting on constructive market activity. When this rolls over and the ratio is going lower, it's telling you that people are rotating more towards defense. And if you look, we've had this stepwise motion after being very constructive through the spring into the summer. That ratio has continued lower and lower. Now, at this point, we're right at that middle point, right, where this could break higher or lower. And the direction of the breakout of this ratio, I think, is going to be really, really interesting to pay attention to. So in terms of an overall read, that's one that I'd be interested in. If you're interested in that chart list, just shoot me an email. As I mentioned, I'm happy to send it over to you. Julius, now I think you want to go through some of the upgrades and downgrades that we're seeing today.
Yep, that's my job for today. And I always like doing that because it gives me a possibility or an opportunity to look into the minds of our fundamental counterparts, because these are the guys that are doing the upgrades and downgrades. What I've done, and people may have seen that before, I've put a bunch of upgrades and a bunch of downgrades in an RRG. The chart on the left, the RRG on the left, shows you the number of upgrades that have been issued today, and I'm going to talk you through a few of them. EAT inside the improving quadrant doing pretty well as an upgrade. I'm not sure. I don't like this chart too much. The relative strength is improving, but it is rolling over, so not super happy about that. Let's take a look at WDC. There's probably no time to cover off all of those stocks. This one I pretty much agree with. Seems to be completing this double bottom formation. Relative strength is improving, and the RRG lines are both above 100, pushing Western Digital further into the leading quadrant, so that's good. Let's take a look at another stock that seems to be doing okay. That's KLAC. That's actually pretty good. That relative strength looks very nice. It's moving to new highs. I'm not sure if upgrading it right now is the right time to do it, because to me it seems that you're pretty late to the game, because you're, from a technical point of view, this stock's sending buy signals for a couple of weeks already, but still that's good. Snap is an interesting one, way out to the right, rotating from lagging into weakening, and that can mean two things. It can be a temporary one, or it can be definitely rolling over, but for the time being, this trend is looking very healthy, very good. We just broke support around 14. Seems to be putting in another higher low. Relative strength still good, so I am with that for an upgrade. And then let's look at one more of these upgrades that I'm probably not going to like. That's UAA, because that is really not sending a pretty good signal on the RRG. And look at this. We are breaking out of this range in relative strength. RRG lines are nosediving below 100, and we're probably broke this rising support line, and we're heading for support somewhere around 16 probably. So I don't think that an upgrade for Under Armour is in order, at least not from a technical or a relative point of view. Let's look at some downgrades. We have one here. Let me look at SAM. That's the only one that is inside the leading quadrant. And well, why would you downgrade that? That looks actually pretty good. I mean, unless you're trying to catch the peak there. I don't like the downgrade. I like this stock. It's looking pretty well. Relative strength, very good. Little bit of momentum separation in the leading quadrant, but still good for me. HEY is probably different. That is another one. Long tail going down. Trend looks still good. That's probably going to be one of these temporary rollovers, because it's very high on the RS ratio line. Doing pretty well there. That's how much time do we have? Oh, I can do one or two more, no problem. HLT, Hilton, why not? That's inside weakening, but closing in on crossing over to lagging. That's actually a pretty good downgrade for me. That's resting at support. If this breaks here, that level around 90 it is, you see that the relative strength is rolling over, seems to be dropping back below its previous high. And if RS ratio drops below 100, we've got the turn into the lagging quadrant. And then Hilton is definitely one of the underperformers. So I would agree with this as a downgrade. And I'm probably also going to agree with RXN as a downgrade. Yeah, pretty wild here. Price chart goes nowhere, but on the relative, you got your signals. Just look at this horizontal line. That's under attack, I would say. That seems to be going, and the RRG lines are nosediving. So that's, if you have any sort of trend going in here, then I would expect Rexnord to move further down, at least versus the S&P 500, and probably also in price. And I'm going to do that was it for the upgrades and downgrades, and we're going to move into a short break, and we'll be right back after that.
The ChartWatchers newsletter features expert technical commentary about the current market from some of the industry's leading technical analysts. See what's really happening in the markets through their eyes and gain an edge in your own investing. The newsletter is packed full of insightful and educational articles intended to help you become a better investor. Whether you are brand new to charting or a seasoned technical analyst, each edition will provide a wealth of informative content. It's the best way to stay informed on all the latest news, events, updates, and additions here at StockCharts.com. Whether it's a new feature or blog, an upcoming conference, or a special sale, you'll hear it first in the ChartWatchers newsletter.
Hello, everyone, and welcome back. Thanks again for joining us today on MarketWatchers Live. I'm Dave Keller with Julius to Kempenaer. Today, Julius and I we've known each other for actually quite a while. I wanted to share that story in a moment. And when we were talking about what to do today, one of the things I've loved about working with Julius for a while now is being able to look at markets, look at the RRGs, look at sector rotation, and then think about what that means for investing, what that means for group themes and individual names and all of that. And Julius, when we were talking earlier, I was sharing the story about how we first sort of connected and how we started working together. This was years ago when you were on the sell side as a research analyst.
That's right.
Selling your research, and RRG was really a key component to your process, right?
Yeah. At that time, it was building up. I mean, RRG was not built overnight. It was not like Sunday afternoon at the drawing table say, "Hey, this is it." So it pretty much grew over time. And right. I was producing sector-based research for my institutional clients, and you were at Fidelity at the time, so you are like prime target for everybody on the sell side. That's true. I believe it was through one of your counterparts in London that we connected, probably at some conference, and we started talking, and I was allowed to start sending you research and try to give you a call every now and then. Usually got the voicemail, which is the problem with everybody on the sell side trying to call the buy side. They always talk to voicemail. But sometimes we actually got to talk to Mr. Keller himself, and I was trying to explain what I was doing. And at the time, I actually... you moved houses and I just moved to a new house. And the good thing about moving to new houses is that you find stuff, but also that you lose stuff. And what I tried to do this afternoon, and I didn't succeed, was trying to find if I could find one of these old reports that I was sending out when you were at Fidelity and bring that up. Because whether you know it or not, you were actually pretty instrumental in further development of RRG, or in a piece of RRG, I have to say, because people need to know that we had email, but it was not like, internet sites for distributing research wasn't like so common ground.
Right.
We're talking 15 years ago, I think, 10 years, at least 10 years ago, at least, maybe 15. So it was all PDFs. It was PDF reports. So I was producing my my monthly and weekly reports on sector rotation and sectors. And one of the very, very early predecessors of RRG was the last page of my report. And it held what's now in RRG with the sectors, with the last observation and the previous observation. So it was only, the tail length was pretty much one. So if on my screen, it would look something like this.
That's right.
That would be the picture on the chart, and it didn't have the scrub chart of the SPY. It didn't have any of that. It had a table below it with the values, and that's it. And I printed that in every report. And one day, you and I were talking on the phone, and talking about this, and then you said, "You know what I do? I always print off the last page of your report." I was like, "Why would you do that?" And do you remember why you said that? Do you remember what you did with that?
Well, absolutely. And it brings to mind how, for years we've talked about technical analysis and just looking at charts, right? So much of it is so simplistically two-dimensional. And there's a lot of value in looking at bar charts and candle charts. We both do that very regularly. Oh, yeah. But what I loved about your work is that it was a different dimension. It was a different way of visualizing it. But when we printed out that last page, we would basically put it in a stack, and then we would flip through the stack of the last pages and we would magically put your RRG in motion and actually watch the rotation happening. And that, I think, is that next dimension. That's the third dimension of a lot of charting is being able to, move it over time and actually see how relationships evolve, how they come together and come apart. And all of a sudden you could visualize risk and return in a portfolio in a much more meaningful way than tabular data, which is what most of us were living in at the time. So it was a fantastic improvement. We loved that. And now what's cool is that, anyone listening here, you actually, to write on StockCharts, you can actually do what we had been doing.
Yeah, exactly. Yeah, I was just going to say, that remark of you, that sparked a new development. And we actually started programming, the possibility to actually make that happen, because we can actually look at the screen. This is what Dave means. This is what he was doing with a stack of papers. Oh, hang on. Let me max that out because then we'll see. So this is what happened with that stack of papers, and look what technology can do for us now. We can actually, make that happen in front of our eyes at the push of a button. So super exciting.
Well, for what it's worth, I'm glad we made that initial connection and have become pretty good friends over time, which is pretty cool about it too. Tell you what, let's put the RRG to work. One of the things we actually look at the consumer sector and consumer staples, consumer discretionary are so interesting with the RRG. They all are, but what I find is so interesting is because it's such a diverse group of industries, right? So you've got a lot of different types of companies. So the RRG and actually seeing how they rotate against one another can be really, really meaningful. So let's start with that. You want to take a shot at some of the consumers?
We're going to do a deep dive. So I'm gonna work my way down from the RRG that you see here, which got all 11 sectors versus SPY in the table below. You can actually on the site change the appearance in a couple of ways. You could, if you want to keep the whole universe there, you can actually tick off the boxes in the table to toggle them on and off. But because what we want to do today is just look at those two sectors, what I then usually do is I just go into the box and select them all and say, okay, I want to look at XLP versus XLY, and just hit enter. And then we have both sectors. Because it's only two, we can actually have a little bit longer tail. We can max that out, so we can actually play around with that rotation and how it goes. Let's lengthen this a little bit to 3 years, a little bit more history, max it out, and then we can actually talk what we're talking about. Because what this is actually showing is that relationship that you had up on your chart list, that XLY XLP ratio. Yeah. That's this ratio visualized in a different way. So you had XLP, so that ratio is going down, which means that XLP is doing better than XLY, and that's exactly what this is showing you, because XLP is further to the right. To the right is good, to the left is bad. XLY is also above 100, and that's one of the other beautiful things about RRG. Everything is comparable. If you put those two as a ratio on a plain vanilla chart, you would have to look at all these individual charts. You would have to look at XLY versus XLK and XLY versus XLE, et cetera, et cetera. But here, we can look at all those relationships together in one chart, because all these numbers are comparable. And what we'll see here is that XLP is ahead of XLY, which confirms what you see on your ratio chart, that XLP is moving, that ratio is moving lower, which means that XLP is outperforming XLY. Institutions are getting more defensive. Defensive is still the game.
Now, what's interesting about this rotation between just the two of them, you've had this unusual movement in the last 2 or 3 weeks, right? So it almost felt, as the market was, going to new highs, you had staples kind of coming off. You had discretionary rotating higher, but now all of a sudden in the last couple of weeks, it seems to be spreading back out. Staples recovering a little bit, for moving further to the right, discretionary moving further to the left. How much weight do you put on that sort of short-term move in the last couple of weeks?
Well, this is what I call these hooks. You would expect a clockwise rotation. That's the general rotational pattern. If we scrub through and we do it really quickly, everybody will see that this is a clockwise rotation. But sometimes you'll see these very sharp hooks that appear to be counterclockwise.
Right.
what you need to do then, and then this is a weekly chart, you need to dive down into the daily, and you see it beautifully here. This is the rotation over the last 23 trading days. So it's like three weeks, a little bit 4 weeks trading weeks. So 4 weeks. So 1, 2, 3, 4. So this hook here on a daily chart actually looks like this, which is a perfect clockwise rotation. It's just, it went too fast for that weekly to be picked up as a trend. So that's why you see those hooks. Where do I put more emphasis? I like to work top down. So the weekly is my guidance, is my my primary trend.
Sure.
When I see stuff like this, I'd like to either get it confirmed or denied on the daily. And what I see here is that XLP is still on the right-hand side, and XLY is still on the left-hand side, and it's sort of turning around right now on the daily. But the question is, will this be strong enough to turn that weekly around? And,
right.
and I have my doubts. I mean, because this is a strong move that's going in the upper right-hand direction, like northeastern direction.
Right.
So for the time being, I'm sticking with a cautious approach based on this rotation between these two sectors.
Sure. And you hit on, I think, one of the discoveries we made when we first started putting the RRG charts in motion, actually looking at how they evolved. I think you noticed you had this simplistic idea, or at least we did in our head, that things would just rotate clockwise. And how easy is this, right? You just watch it happen. But in reality, a lot of other things can happen. And looking at the direction, the angle that things are moving and how they reverse, and when they, what you're calling hooks, where, it actually changes direction. A lot of times, some of the more meaningful signals or indications that things were evolving would be from some of those shorter term moves. It wasn't just the rotation around the benchmark. It was actually how some of them individually were moving. But I like here how you're combining the weekly and the daily. There's a great lesson there, I think, for all charting, right? Even just looking at bar charts, right? A lot of times we get really stuck on the time frame we're operating on. We're looking at a 6-month daily chart, and that's it. And here you're actually showing how combining some of the long-term and short-term actually gives you a sense of how the short-term movements fit into the long-term trend. And don't lose sight of that, right? That's great.
Yeah, absolutely. And the good news is they continue to rotate clockwise, because if we have a hook on the weekly and we can see it rotate on the daily, if you have some sort of a hook on the daily, then you can see that clockwise rotation on the hourly or the 30-minute chart, etc. By the way, we don't have that available yet, but the good news is that we're probably going to get that fixed at some stage, because everything is now in the cloud, and I hope that Chip will make available some programming capability, because it's on the list for a long time already, to enable to have RRGs running on like hourly, 30-minute, 10-minute, whatever terms data, so we can cater for the shorter term traders, but also the monthly, so we got some of the really long-term trends, because I've got a lot of questions on how to do it for really long-term trends as well. So yeah, I'm pretty excited going forward with the stuff that we got in store.
Absolutely. So this makes sense from, looking at staples, looking at discretionary, as you sort of mentioned, on the long term still feels a little more defensive, right? A little more cautious, more skeptical. Yeah. Do we want to take a dive into one of those, and let's look at some of the group and stock themes within there? Yeah.
One of the things, and I think that maybe a lot of people, well, I'm pretty sure that a lot of people don't know it, because we got a lot of data on StockCharts, and here we look at sectors, but these sectors are subdivided in groups, and then come the individual stocks. Now, if you go to the sector summary page for the S&P sectors, you'll see all these lines that give you these 11 sectors. We all know that. But if you look closely, and we're going to, which one do you want to start with, staples or discretionary?
Let's go with discretionary.
Let's go with discretionary. Okay, so if we look on this line, all the way on the back here, you see 3 icons. The first one, clicking you, gives you a market carpet. The second one gives you a perf chart. And these 4 squares replicate an RRG. So if I click on that RRG, I get an RRG that's filled with groups that make up that sector. Now, one word of caution here. There's a lot of legacy in these groups in terms of data on StockCharts, and I've been working hard with the data team to get those aligned. We're not 100% there, but very rapidly we will have the ability to have all these groups seamlessly tie in with the sectors. So you won't have any discrepancies anymore between classification, because there are multiple systems in play, and we needed to align all of that, and a lot of that work has been done right now. So if you're listening and you've been one of the people who've been alerting us to discrepancies either in sector classification or group classification, we've been working on that, and we're pretty close to releasing that all-aligned setup that gives you groups versus sectors. And this is the RRG for the groups. The only thing I'm going to do here is change the benchmark to XLY. So we have apples and apples and oranges and oranges.
Right. So now we're looking at all the industries and then how they're rotating around discretionary as a sector, right?
Exactly. Yeah. So, and then the cool thing that we can do is we can actually, we've seen this, we've got the groups here, and in the predefined groups, if we go to XLY, we can load up all individual stocks inside the discretionary sector. And now we have two things that are pretty cool. So the individual stocks, we got the groups, and the table below, we can actually rank or sort by industry. And then, ta-da, we can actually see that, look, which one is this here? It's
the home improvement.
The home improvement. Now look at, so here are home improvement retailers. So that's Home Depot and Lowe's are actually pretty good. This sector index probably holds more stocks than just the two here, because these two are the ones in the S&P 500, right. And this one may also have mid and small cap items in there.
Interesting. So what's cool about it, and you're right, this is going to capture sort of the S&P members. And again, if you know about how these indexes are constructed, those big names like Home Depot and Lowe's are going to drive a lot of that index because they're the biggest names, right? But it's worth noting, and I'll just as a teaser, the industry summary page. That's where I spend some time, because that allows you to actually go even deeper and then see not just Home Depot, Lowe's, what are the other names underneath there, and actually see what maybe mid cap, small cap stocks are of interest. So a lot of times the process that can be of interest is you look at what makes sense on the RRG, what's rotating well, what you think is of interest. Go to the industry summary page. You can actually drill in and see what makes up that index, and then also what stocks underneath there that might be of interest to you, right?
This page, you mean, right? What you're looking at right now? Yeah.
Home improvement retailers, then you can go through there and you can actually see what stocks are going to.
Home improvement retailers. Here you go.
Right. So now this is that group in particular separately.
Yeah. And then the members, boom, here you are. You see, so actually, and if here you can sort it. So here's the two in large caps. That's the two that you saw on my list here on the pre-prepped. And here you see that the other ones are all mid and small caps.
There you go. And then pro tip, if you actually sort that by the scooter rankings, so this is bringing in another StockCharts component, right? This is the proprietary blend of a number of different indicators showing you, just a quick ranking of where they're at. That'll show you more longer term what's been working and what isn't. Now you start to see some small and mid cap names that are bubbling a little higher than Home Depot and Lowe's. And again, not saying that you absolutely need to grab one of these, but maybe worth digging a little lower, because a lot of times the bigger names are not at the top or bottom of the list. There are other opportunities that might be out there.
Yeah, let's see. I'm not sure, but I'm going to try something. What would happen if I do sector RRG? Will it? I wonder if it brings me the sectors. Got to talk to the guys. It would be cool if we could throw all these on an RRG now.
Oh, right. Jump right from there.
Jump right there. So I have this list there. So this is, if you want to do a deep dive, because that's where we started out. We started at the sector level. We looked at those S&P sectors. We singled out XLY and XLP. And now we've been looking at individual or the groups that make up the discretionary sector. That's all these groups that you see in that table. And then we can actually work our way down to the individual stocks and make up our mind about what we think about some stocks. So, Dave, which stock would you like to let's go for one very good group and one very bad group in this discretionary thing. So that's the home.
Yeah, we started looking at home improvement retail, right, which is Home Depot and Lowe's. You can see that on the RRG rotating into the leading quadrant. Let's take a look at some of those larger names, and let's grab a couple of them. Do you want me to grab the screen and look at some charts? Or do you want to go ahead?
No, why not? Go ahead.
All right. So here's what we'll do. Let me grab the screen real quick here, folks. Dun, dun. And I'm, here I'm looking at sort of my own screen now. I'm looking at the tabular form of it, but grabbing some of these lists. So here I'm looking at home improvement retailers, sorting by scooter rankings, and now I can see, a small cap name, BMCH is at the top, Floor and Decor Holdings, FND is next. Then I get to Home Depot. That's maybe where I want to start. And again, not that, all of these names are obviously very different. There's a lot of different movements you can see here, but the largest names are what are going to drive a lot of the returns within that industry index because they're the biggest cap weight. So in general, that's when people are looking at home improvement retail, they're thinking of the two big ones, Home Depot and Lowe's. So let's, think of this in a vacuum. There's a reason, or it probably makes sense as to why that has rotated into the leading quadrant, why it looks so good. And again, I always go back to technical analysis 101. We have a consistent pattern of higher highs, higher lows. When Home Depot's pulled back to a significant moving average, when it's pulled back, it's not broken often below its most recent swing low. It stayed with the stepwise motion, higher. And then just in the last 2 weeks, we've seen it hit the resistance from July, faltered a little bit, and then gapped up and now has remained higher. Now, in the last couple of days, we're seeing a little bit of a distributive pattern. If you're a candle chart follower, you probably recognize that's a little bit of a worry, sort of this short-term reversal pattern. But overall, the long-term trend remains pretty strong. And this is the relative strength, which again is not a direct, component of the RRG, but really drives the RRG, right? Looking at the relative strength. And the fact that this has been a consistent outperformer is why that group, I think, has looked so strong. And so, in my opinion, this remains in a pretty positive configuration. If we do pull back, you have, some good short-term support to pay attention to around 216 or so. That would be the low from the beginning of last week, the week before that. And as long as we remain above there, then this upside trend remains in place. And as long as the relative strength remains constructive, I think that's a pretty interesting chart to pay attention to.
Yeah, I've just isolated Home Depot and Lowe's on my RRG, and what you can see there is that Home Depot is inside the leading quadrant, but it's got a very short tail. All these week-to-week observations are very close together. And that tells you that it is a very solid, gradually growing trend. Right. It's not a race car. It's just a solid marathon, just going higher and higher and higher. Whereas Lowe's is inside improving, but it's got a much longer tail, which tells you that it's catching up with Home Depot. It's making large gains from week to week, and it's rapidly improving to catch up with Home Depot. So, if you want some actionable views and ideas, Home Depot is your core, your holding, that steady stuff, and Lowe's is where the opportunities are. That's probably what you want to pick up, on any dips, or just buy it outright because you like that group, because it seems to have the potential to move faster than Home Depot in the next few weeks.
It's a great point. And, looking at the chart of Lowe's now on the screen, it's recently overbought after this big move up here. So it was a little more extended maybe than Home Depot was. But, so with both of those short-term distributive patterns, you might expect a little bit of a pullback. But overall, I mean, long-term constructive could be an interesting time to buy on the dips if you buy into the long-term uptrend. But you made a really good point, and I think that's where I've always found the RRG can be helpful is, right now I can go back and forth between the chart of Home Depot, the chart of Lowe's, and do my analysis between the two and then start to think of how they relate. But on the one RRG graph, I can actually see the two of them together and actually how they're moving relative to one another. There's a lot of value in that, especially, again, your world is not made up of two stocks. It's 2,000 plus, right? So
exactly,
the ability to sort of sort through it, I think, can be pretty helpful. I'll tell you what, do you want to take the screen back and let's look at maybe a group that has been less constructive, maybe on the something that looks less attractive based on the rotations, and let's dig into that.
Look, here's the tail on Lowe's,
right,
and here's the tail on Home Depot. You see what I mean? So the Home Depot is really short. It's like boom, 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 just steady going, and then you got Lowe's is like bam, 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 and it's increasing every time. So that's where the power is, and that's where the Home Depot is where stability is. Yeah, I was looking at if we stick with consumer discretionary, USFH, help me out there, furnishing index, furnishing. Let's see what that is. And I then have to go to that sector summary page again. No, industry. I need to go to industry.
Yep, that's right.
Yeah, so here you go. We are amateurs. We're not. We're just winging it. Industry summary.
There
Here you go. There you go. And then it's discretionary. And I need to go to
furnishings there at the top.
Here, furnishings. There you go. And then the list. There it is.
So these are some interesting.
Which stocks are we going to look at?
Yeah, so like Mohawk jumps out at me, right, on MHK.
Yeah, let me see, because what I needed to do is give you that discretionary thing. If I was looking at furnishings here, this is what I wanted to do. Oh, there's only one here. Oh, Mohawk. That's the one you were talking about. There you go. That's the only one in the S&P 500 of all those stocks.
Yeah.
Oh, there you go. Yeah, and that they look alike, and there is probably a reason for that.
And this is a good lesson in how you drill down in these things, and you're absolutely right. So what's happening is basically that one stock Mohawk is what's driving that industry level RRG, because it's the one big stock within that group. But if you look at the industry summary, you can see there are a lot of other names.
Yeah, there's a lot of them. Yeah, exactly.
That you're probably even familiar with some of those companies. You bought their furniture, but seeing where they're at and how they relate to the big cap names. And so it's MHK and LEG are the two large.
Yeah, LEG. Yeah, exactly.
So those two. So if you wouldn't mind just bringing up a chart of Mohawk from there, or looking.
No problem at all.
It's in the lagging quadrant. If we look at a chart of Mohawk, you'll see why this is a less attractive name, relatively speaking. And I use relative, pun intended there.
Yeah.
Look at the relative strength and how it's just been essentially deteriorating over the last.
Here's your relative in the middle.
Yeah. And then at the bottom, those are the two lines that make up the scatter plot, the RRG that we're familiar with. You see how those have rotated downwards as it's rotated into the lagging quadrant. So this is a stock. If you look at the daily chart, you'll see a similar thing. It's almost a bear flag pattern that we're seeing right now, where it's had a big sell off and then just a little bit of an upswing, but overall, there's not a lot to be excited about. And again, in general, I've always told people, don't confuse the bottom of the page with support. If a stock keeps going up, just because it hit them, and it's funny, in my previous role at Fidelity, we had this huge monitor, and we'd always joke when the price would hit the bottom of the TV screen, that was not a reason to be buying the name, right? Because
remember when we had RRG up on that screen? That was awesome. I have pictures of that.
So again, it's a good reminder that usually when prices go down, it's gone down for a reason. It's not to say that there aren't bargains out there, and I've known plenty of deep value investors that do just fine as with performance. So it's not to say that it doesn't work, but I would not use it being very low as being the sole reason to pay attention to something. And if you look at just the far right side of that chart of Mohawk, you can see it's had a steep sell-off down at long-term support. A little bit of that flag as it's come back up a little bit. But overall, it's pretty close to where you would potentially break to a new low. You violate the downside of that pattern, and boy, that would be sort of a warning signal for.
Here's your daily.
Not my favorite, right? Not my favorite.
No.
Friend follower. It's hard to get excited about.
But you know what? I mean, if we bring it back to some actionable ideas, and we stick with discretionary, we've seen Home Depot and Lowe's in a group that's doing very good, and now we see Mohawk in a group that's doing not so well.
Right.
If you can trade long, short, or you trade options, or I don't know how you run your portfolio, but if you're able to initiate and manage pair trades, then I think either buying Lowe's and selling Mohawk, or buying Home Depot and selling Mohawk, would be a great trade. And you mitigate the general market risk, and the odds for Mohawk going up or Home Depot going down are a lot less than Mohawk going down and Home Depot going up. So, for me, if you look for pair trades, this is the type of trade that I'm looking for to put on.
Well, Julius, when you and I spoke earlier this morning over coffee, we agreed that 30 minutes would probably go by very quickly, and sadly, it's done. It's done.
It's done. Yeah, I know.
But we know it. And again, what I hope we've illustrated here with this deep dive is just the depth to the platform of what we're able to do, starting with the big picture, looking at sector rotation, drilling into some of the stories, some of the movements, and identifying some names that might be at actionable points. And we've highlighted, a pretty solid group and a pretty weak group, but there's another level of looking at all the different groups and how they're rotating around one another. So, listen, maybe, if the people get what they want in your blog, you could share a deep dive in staples at some point and fulfill the other side to what we
that's a good idea.
To see. And
coming up.
Yeah, we're rounding out the hour together. Thanks again for sticking on with us. What we wanted to do is switch to the 10 and 10.
Yep.
And this is a regular segment where we like to look at some of the names that have been thrown around. Julius, why don't you start it off?
Yeah, I just got the 10 and 10, so I've thrown them what I always do with Tom and Aaron when I'm on the show. I look at the 10 and 10 from an RRG point of view, and I just look at these and the ones that I think, K looks very good to me, STZ nicely, SLVP, WPM, solid uptrends. I don't like SQ, PFE. Snap, we've already seen earlier, probably a temporary hiccup. MDCO, this is one of the stuff that I'm looking for on RRG, especially if it's so far to the right. So I haven't seen the chart. I have no clue what this stock does. Well, it does medicines, but I don't know the chart. But I'll bet you it looks pretty good. So you can look at it from there. And then info is stable, not very good. STZ is pretty good. That's probably, look at that. That rotated just back there and hooked back up. That's probably also a very strong chart. And then Microsoft, I'd be careful. The tail is still very short, which is good. It means that it's still stable on the positive side, but might keep an eye on it for the time being. So you take it away, and we start with K.
Perfect. So thanks for that. And again, as we've hopefully illustrated, I think looking at the RRG as a starting point, if you're looking at a group of names, cannot tell you enough it's just a great starting point, and it tells you which charts you should be looking at instead of getting too caught up in the weeds. So starting with Kellogg, right? This is, if all charts looked like this, I'd probably feel pretty good about myself if this was a portfolio that I own, because here, what I like to see is a classic rotation from a distributive phase to a consolidation phase, a sideways period, and then an accumulation phase. And there's been this rotation of where there's been distribution to now accumulation. And I like the breakout above long-term moving averages. I like the breakout above resistance here from the end of April. It's now gapped up probably on earnings. It's now settled down a little bit. And overall, this is the type of name you'd like to own. You've got upside to previous highs. And so Kellogg is actually a pretty compelling name. Love to see the relative strength continue a little further up there.
Okie dokie. And then the next one up is MDCO, medicines.
Right. So medicines co. Boy, this is again, this is a great name that's rallied. It's broken to new highs. What excites me yet also concerns me is the momentum, right? And if we look at the bottom, this is the RSI, just looking at the price momentum, average up day versus average up day. How extended is this stock relative to how it normally trades? The fact that it's overbought, again, all else being equal, tells you that you're probably coming up to a pause in the trend. And we saw that out of the initial move out of the lows in February. You saw that again at the beginning of May, saw the beginning at the beginning of June. It didn't mean that the trend was over. It just meant that there was a little bit of a corrective period, a little bit of a pullback. In this case, an opportunity to add to the position. What's happened now is you've broken out to new highs. There's a reason why the stock has gone higher. That's encouraging. But now we're overbought, which again usually suggests a little bit of a pullback. But we're nearing what I always call the good overbought, an RSI above 80. And again, I'm summarizing very quickly here. But when a stock becomes that extended, the momentum is that high, usually there's further upside overall to be seen here. So, again, short term, a little bit of concerning because it's so extended, but boy, you like the long-term action. It becomes extremely overbought. I think it could be of interest.
Cool. Next one, SQ, Square Inc.
Square. Yeah, so the payment processors, right? These are names that, long-term have been really, really interesting, but you look in the short-term action and they've been, Square has actually been kind of depressing here, right? It's sold off a little bit, had this huge gap down when it broke below 78, right? That was sort of the line in the sand, as long as we stay above there, the trend is in place. Boy, that ended very, very quickly. Now we're below the 200-day moving average, below 2 declining moving averages. So again, as a trend follower, this is not the type of chart that I would certainly enjoy. However, here's what's really encouraging is if you look at the 60-61 range, we're right at support, right at a level below which we've been unable to go. We're right at a range where buyers have traditionally come in. So the risk reward is actually kind of compelling here, but this is the type of chart where, I think you have to keep stops relatively close, maybe 60, for example, which would be the low from June. As long as we stay above there, it's okay. But it might be an interesting one to take a plan. But you'd like to see some accumulation first.
Yeah, nice divergence in the RSI as well. So
Agreed.
WPM, Wheaton Precious Metals.
All right, we're going to go quickly through the remainder ones. And again, as I mentioned earlier, I sort of said if all of the charts look like Kellogg, I changed my mind. I would say WPM may be a better example of the I wish chart. If they all looked like this, life would be pretty easy. Right? This game's easy. This is a chart that's just been in a consistent uptrend up and to the right, long and strong. It's become overbought a number of times, but it's pulled back. The RSI's never really gotten below 50 here in the last 3 months. Breaking to new relative highs. It's a fantastic chart, a fantastic trend. It's a very constructive.
Cool. Now let's move to Snap.
Right. So Snap is I've often talked and when I've been on the show before, I've mentioned the fat pitch chart, which is sort of the baseball slang for something you have to take a swing at. And the summary of a fat pitch chart, in my opinion, is something that's a long-term uptrend and a short-term corrective pattern, right? So it's not vertical. It's not going straight up. It's pulling back a little bit. So again, if you're an institution, you have the ability to add on volume and not worry about messing with the market too much, not worrying about having trouble getting filled or liquidity issues. And so the fact that the stock has been in a good uptrend, it's pulled back, it gapped up and came back a little bit, but right at the 50-day moving average, it's actually a really interesting time to be buying on weakness. On this chart, I'd be looking at the RSI, and as long as the RSI remains above 40, then that tends to coincide with bull phases. If it gets below there, you have to worry a little bit about maybe more of a correction.
Okay, SLVP, iShares Global Silver Miners ETF.
Yeah, I was going to say, I was wondering with the 10 and 10, how much people would bring up an ETF, especially a commodity ETF. We were talking earlier this morning about gold and thinking about how that's rotated. And long-term, precious metals have these fantastic setups. This is a daily chart of silver. You can see how it had this nice run in June and July, this corrective pattern, sort of the sideways pattern between 1060 and 940, broke out above that. So that's a really interesting continuation pattern. Breaking to new highs again here. What concerns me about something like silver is this emerging potential divergence. And it's not done yet. This might actually resolve and go higher. But if that sort of comes back a little bit and you have this bearish divergence of higher highs, lower highs in the RSI, I think it could be concerning. But overall, gold and silver look really, really interesting, especially on a long-term basis.
Cool. Next one up is Pfizer, PFE.
So, healthcare has been, I would say, frustrating. And one of my former colleagues, former analysts, always used to talk about Microsoft, actually, in particular. But he liked to point out stocks that don't chart well, was the way he described it. And it's basically just, as much as we have these great rules that have stood the test of time, sometimes the charts just don't make a ton of sense. And I would say Pfizer back here has been one of those frustrating things, right? You had a breakout in June and July and what we'd call a failed breakout, right? It immediately rolls over. So if you bought the new highs list, if you bought the stock going higher as the market gets constructive, you got very disappointed. All of a sudden, it turned into more of a head and shoulders topping pattern, breaking down through the 200-day. And this is why you look at head and shoulder patterns in the 200-day moving average for examples like this. What's happened now, though, is it's become oversold. It's gone down, it's gone down a great deal, now below the RSI below almost down to 15, right? But now it's come back up here. So again, as a value-oriented investor, I'd be very interested in something that's rotated higher, relative strength starting to improve. One of the things I tend to look at is a 13-week high, which is sort of a 1 quarter. So you like to look for things that have appreciated enough that they would start to bubble up to making a new 13-week high. Unfortunately for Pfizer, this has a long way to go for something like that. So what I look for on a chart like this, to be honest with you, is some sort of pullback, a higher low, which we have not had yet. This may be a little one at the bottom, but I'd love to see more of an intermediate low that can make this more of a buyable chart.
Sounds good. Sounds good. Let's move on to Constellation Brands, STZ.
Right. All right, we'll go very rapidly through this one. This is a fantastic chart where you've had a nice rally, come back a little bit, and again, a consumer name here that we're looking at. I love the action today, and if we remain above that resistance level of 205, next resistance 212.50, but overall higher lows, very constructive, and I like the relative strength going to new highs for the year.
Great, and you can move immediately on to info, INFO, IHS Market.
Yeah, so market, right? So this is an interesting one. This is teasing new highs. And again, it's gotten up to that resistance level from July, pulled back a number of times, buyable at the 50-day, and overall very constructive. We break out here. I think you see a lot more interest in the name, and relative strength undeniably strong. I think it's a really interesting chart long term.
Cool. And then the final one is Microsoft, MSFT.
This is one that you did not sound as excited about, and I'm not surprised, right? So this feels like a trend that's stalled, and I'm saying that not far from their headquarters here in the Pacific Northwest. This has been a strong relative performer. It's one of the biggest names in the world, and the relative strength has stalled a little bit. I would be concerned if this rolls over and you start to see new relative lows. We haven't seen it yet, but especially like breaking below the relative low that we set in July, that would tell me to be more concerned than I am. At this point, it's holding up okay, so it's not too bad long term, but boy, breakdowns of support I think would be really telling for something like Microsoft.
Yeah, on the RRG, it still has the opportunity to turn back up, but it has to happen quickly.
So that was the 10 on 10, folks. Hopefully that was of interest to you. And again, this is a really cool feature. I love the fact that there's an interactive nature to MarketWatchers Live, and I'd encourage you to keep tuning in and coming back to that. Throw in names that you're interested in, and let's keep paying attention to them. Let's move on to the poll here. We had asked you earlier, just very quickly, about the industry summary page, and I mentioned we were going to refer to it, and we did. We brought it up a little bit, and wanted to know how often you actually refer to this. I am somewhat encouraged by the fact that our listeners have actually paid more attention to this than I feared. If you're looking at it once a day, you have a pretty good read on what's moving those sectors. And I find a lot of people end their analysis at the sector level. They're looking at the XLY and they think that's it, consumers doing well. But there is so much more if you look even one level below there, to say nothing of the deeper dive we did today. So not too bad, Julius, right? Encouraging in terms of what
It's like what's the analogy I came up with? It's like driving a car, you sit in the car and you drive let's say, I don't know, a Ford or a Mercedes or a BMW, and you think, oh, this car drives very nicely. And then you open the hood and you see that there are all these parts that make this car drive, and you can actually drill down into these, you can drill down into the engine, drill down into the tires, into the axles, and then, you can take it all apart, and you can do that with RRG and with these sectors and these groups and all the tools that we have on the site, enable you to pretty much take the car that's called the stock market apart in all these various parts and drill down and figure out what you like best, and maybe fix the parts that are not functioning properly.
It's great. So if you describe yourself, or if you answered in the lower end of the poll that you do not pay as much attention to the industry summary screen, hopefully you got a good sense of how to do it. I'd encourage you to do so. That's how you're going to move to the next level of using stock charts and investing in the equity markets here. Well, we're going to wrap up here with just a quick update on what we're seeing with the broad equity markets. As we've seen, definitely more of a corrective movement from the day. The S&P on the last snapshot down 85 bips, 85 basis points, just under 1%, and the Nasdaq, the more speculative, more technology oriented, over 1%. Down. Moving down here, we see small caps leading the way down. And again, in terms of defensive movements, that's what concerns me when you see small caps leading the way down. As we mentioned earlier, we've been looking at consumer staples and discretionary. The defensive parts of the equity markets are what are leading today: utilities, real estate, staples, and then things like financials, industrials really lagging behind. And tech down there is not what encourages me in terms of long-term strength of the market. So again, this is one day. We'll see how things start to evolve, but it's a good starting point there. Again, as a reminder of the upcoming schedule, we have Linda Raschke, Bruce Frazier later this week, both fantastic investors and very knowledgeable, good educators both. So I'd encourage you to pay attention to those. And then Aaron's workshop next week on September 10th. Julius, this has been a pleasure, my friend.
That's great, Dave.
Everyone, thanks so much for tuning into MarketWatchers Live. We appreciate you paying attention, and we'll see you next time from Dave and Julius. Thank you.